All right, let's dive right in. Today, we're tackling one of the great debates in business, a question every successful company has to answer. What on earth do you do with the profits? It's a choice that really pits today against tomorrow, and it gets to the very heart of how companies create value for their shareholders.
So let's make this real for you. Imagine you own a piece of a company. You're a shareholder, and they just had an amazing year. They're sitting on a cool $1 billion in cash profit. What's the best move here? What would you want them to do with that money? As you're about to see, it's not nearly as simple as it sounds.
When you boil it all down, there are really two main paths. The company can pay you a dividend, cut you a check, put cash directly into your bank account right now. Or it can take that money and plow it right back into the business. We're talking new factories, more R&D, expanding overseas, all with the goal of making the company bigger and better, which, hopefully, makes your stock worth a lot more down the road. So, cash now or growth later? That's the dilemma.
Now, for a long time, the answer to this seemed pretty obvious, and that brings us to our first school of thought. We'll call them the traditionalists. Their whole philosophy is really intuitive, and it's perfectly captured by that old saying, a bird in the hand is worth two in the bush. This is the guts of what's known as the bird-in-hand theory, which was championed by thinkers like Myron Gordon. And the logic is really powerful, right? $1 in dividends today is a sure thing. It's real, but the promise of a higher stock price in the future, well, that's just a promise. It's uncertain. And investors, being smart people, would much rather take the certain cash than gamble on an uncertain future. And for decades, this wasn't just some academic idea. This was the gospel on Wall Street. The godfathers of investing, Benjamin Graham and David Dodd, basically argued there was a direct line between the two. A company that paid out high, consistent dividends was just flat out more valuable than one that didn't. It was seen as the clearest, most honest way to reward the people who own the company.
But then, in the early 1960s, a couple of professors came along and just turned this entire way of thinking completely upside down. Their theory was so radical, so against common sense, that it ended up winning them a Nobel Prize. So welcome to Camp 2, the Radicals.
And here it is. This was the bombshell from Miller and Modigliani. Their argument, a company's dividend policy is completely irrelevant to its value. They said, look, what makes a company valuable is its ability to make money, its earning power. How you decide to slice up that money between paying shareholders and reinvesting, it makes absolutely no difference to the total value.
Okay, I know what you're thinking. How could that possibly be true? Well, Miller and Modigliani, we'll call them MM, built their theory on a foundation of perfect world assumptions. Think of it like a financial utopia, where there are no taxes, it costs nothing to buy or sell stock, everybody knows everything instantly, and the company's big plans are already locked in.
The best way to wrap your head around this is to think of the company's value as a big pie. If the company pays you a $1 dividend, they're basically handing you a slice of that pie. But, and this is the key, at that exact same moment, the value of the company, the rest of the pie, shrinks by exactly $1. So your total wealth, the slice in your hand, plus your now smaller piece of the pie, is exactly the same. Your net worth hasn't changed one bit. And that right there is the multi-billion-dollar question, isn't it? The MM theory is brilliant, it's logically airtight, but only within its own perfect little world. Our world, the real world, is messy. We have taxes, we have trading fees, and critically, some people have way more information than others. So what happens when this perfect theory crashes headfirst into reality?
This is where things get really fascinating. Because as soon as you start adding back all the messy complications of the real world, all the things the MM theory ignored, you find out that dividend policy absolutely does matter. A lot. Just not for the reasons the old-school traditionalists thought.
First up, we've got something called the signaling effect. In the real world, the CEO and the managers know a ton more about how the company is really doing than we do on the outside. That gap is called information asymmetry. So a dividend isn't just cash, it's a message. When a company starts paying a dividend or raises it, management is signaling to the world, hey, we're doing great and we expect to keep doing great. And the flip side is scary. A surprise dividend cut sends a powerful signal that management is worried.
Next, there's the clientele effect. It just means different investors want different things. So a big, stable utility company that pays a high, predictable dividend is going to attract a clientele of retirees who need that income to live on. Meanwhile, a hot tech startup that pays zero dividends will attract young investors who are hungry for massive growth. If a company suddenly changes its dividend policy, it risks ticking off its loyal shareholder base.
And finally, the really big one, real-world frictions. I'm talking about taxes and costs. In a lot of places, the profit you make when a stock's price goes up, that's a capital gain, is taxed at a much lower rate than dividend income. So if you're a wealthy investor, you might actually prefer the company to reinvest the profits and boost the stock price, rather than pay you a dividend that's going to get heavily taxed. These frictions have a huge impact on what you actually get to keep.
So here's the bottom line. Real companies don't live in a textbook. They operate in this messy middle ground where they have to blend all these competing ideas. They know dividends send a signal, and they know who their investors are, but they also have to worry about taxes and, having enough cash to actually run and grow the business. So let's look at how this actually plays out.
This chart just perfectly illustrates a company's financial journey. A company's dividend policy grows up with it. When it's in that early pioneering stage, it's a high-risk startup and it's reinvesting every single penny back into the business just to survive. So of course, no dividend. As it hits the growth phase, it might start paying a tiny symbolic dividend. By the time it reaches maturity, it's a stable cash-generating machine paying out a big chunk of its profits. And in decline, it might pay out almost everything it has left.
Now let's talk about a really popular modern alternative, the stock buyback. Instead of sending dividend checks to everybody, the company uses that profit to buy its own shares back from the market. This reduces the number of shares out there, which boosts the earnings per share and, in theory, the stock price. And for a lot of investors, this is way more tax efficient, because you only pay capital gains tax if and when you decide to sell.
But for all the different strategies out there, one thing remains true for most big, established companies. Predictability is king. They know that Wall Street absolutely hates surprises. So their goal is usually a stable, slowly growing dividend. Why? Because it screams financial stability, it attracts the big, long-term investors like pension funds, and most importantly, it avoids the terrifying signal of a dividend cut, which the market almost always sees as a sign of deep, deep trouble.
So, after navigating through decades of financial theory, from the traditionalists to the radicals and back to reality, what does this all actually mean for you? What's the big takeaway from all this?
It's this. The decision about paying a dividend, how much, how often, whether to grow it, has become so much more than just a math problem on a spreadsheet. It's not just about the numbers anymore.
At the end of the day, a dividend policy is a narrative. It's a story that a company tells the world about itself. It's a statement about its past, how stable and successful it's been, and it's a promise about its future, about its ambition and its confidence.
And that's really the tool I want to leave you with. The next time you see in the news that a company is raising or cutting or starting a dividend for the first time, don't just look at the dollar amount. Ask yourself that deeper question. What is the story they are trying to tell me right now? Thanks for tuning in,